Welcome everyone to another episode of Deal Clinic. I'm Adrian Cormican, and today we're going to be giving you our top 6 mistakes that we see when raising real estate finance. In truth, we could probably give you 25 plus, but we're going to keep it under 25 minutes today, including time to answer any questions at the end. So roughly 20 to 25 minutes. Speaking of questions, we'd really like some. Thank you to all those that have been here previously and have asked questions. It really does help. Put us on the spot and we'll do all we can to answer them. There's 2 ways to ask. You'll see in the top right-hand corner a single bubble, which is a private chat, and only Martyn and myself will see that. You'll also see an icon with 2 bubbles, which is a group chat, where all the participants will see your conversation. I'll be monitoring both throughout and field the questions where appropriate. But rest assured, even if the webinar has ended, we haven't addressed your question, we will collect it and come back to you directly. Now, webinars can be a little bit soulless for us. You're stuck in a box or in a room, and I can't see you, which is a bit of a shame and a bit awkward. But what does let me know that we're on the right track is either you guys asking a question or you hit one of the buttons that I'll launch below in a few minutes. That includes our LinkedIn pages, signing up for a future webinar, or randomly, and something we started quite recently, signing up to our Instagram. I'm checking over here. We're doing something a little bit outrageous today. We're on Instagram Live. So hello to everyone on Instagram Live. I can see them signing up there now. Come and say hello on Instagram if you are on there as well. It'd be great. Something new that we're testing. LinkedIn is where we've always been, but we're trying to spread into other areas now. Now, all that leaves me to do now is introduce my co-host, Martyn Pollock. Martyn, how are you today?
Good afternoon, one and all. Good afternoon, Adrian. I'm Martyn Pollock, co-founder at Hallcroft. Little confession I thought Adrian didn't make was he's actually wearing shorts at the moment, so don't get fooled by that lovely shirt he's got on at the moment. He's actually got cargo pants on under there. Welcome to the Deal Clinic. Martyn, what is the Deal Clinic? Well, the Deal Clinic is basically our way of adding value back to the market. It was initially intended to be an open forum for developers to come and talk about their problems, and we could help them with any issues they had. Well, you developers are a suspicious lot, and you don't ask that many questions initially. So we've taken the bold step to present what we think are the issues and the complications arising from the market. And hopefully anyone watching this will gain a good idea of what we do on a daily basis, and hopefully you'll learn something today. So today, I'll start with an introduction on our business. I'm extremely passionate about Hallcroft, so I'll try and keep that as short as possible so we can get on to the meat and the bones and get into the Deal Clinic. I'll talk about the Deal Clinic. Adrian and I will be throwing a few ideas around. Again, going back to what he said, feel free to ask any questions at any time. And then we will have an open forum and you can ask any questions you want and we'll go from there. So on to our business, founded by Adrian in 2010. We were initially, I guess, some people would say we are experts in development finance. However, we are a 3-partner property finance brokerage, and we sit across the entire market, arranging anything from commercial mortgages, investment facilities, portfolio refinances, development finance, and the rest. I'll go on to do a full product list later on. The business is really split into 2. We have our advisory business, which represents and works with SME developers on a day-to-day basis. And we have another side of our business, which is an unregulated mezzanine fund, where we have grown that business piecemeal through our success with clients, where we've backed them through their successes, got confident with them when they've got confident with us. And that's something that we'll talk about more and more as we do more of these episodes. Our team is strong and extremely experienced. Raymond Sykes, our chairman, is ex-Butterfield Private Bank MD. And we have Douglas Noble, who is the head of our Scottish office. He's ex-Barclays Private Bank. And we have 2 extremely successful marketing consultants as part of our business that help us promote these Deal Clinic webinars. So a big thank you to them with all the hard work they've been putting in recently to get this to be our biggest Deal Clinic yet. Our product. So what do we do on a daily basis? I think I mentioned this the last time, that a developer client of ours came to us with a commercial development opportunity and asked our advice on who could help arrange funding for that. I was taken aback by that because that's something we do on a regular basis. And so I just thought it would be important to touch on what we do on a daily basis. Development finance, short-term finance, be it bridging, commercial mortgages, commercial investment. And don't forget, it's not just debt we arrange, we sit across the entire capital stack, so we're arranging equity on a regular basis as well. So on to the Deal Clinic.
Yes, Martyn.
Six costly mistakes to avoid when agreeing. It says real estate finance. We're going to focus deep dive on development finance, and we'll be unapologetic about that. So, Adrian.
We're trying to stay on time, aren't we? So, Martyn, come on, kick us off with the first one. And thanks for busting me on the shorts. I thought we weren't going to discuss that. You said we weren't going to discuss it. Can help yourself. Not comparing with apples. That's one of your favourite ones. You kick off with that one for us, please. Okay,
so to give you an idea of the process in our business, a client will come to us and they will have a due diligence, a pack of due diligence, a data room. We'll then take all of that information, we'll do our own market synopsis, and with the consent of the client, we'll approach the market. Whether we approach the segment in the market or the entire market, depending on what our client really wants, we will come back to our client with a market review of some sort. Now that will, again, could be a list of 3 lenders, could be a list of 20. Just by way of promotion in our business, we are a transparent business, and when we do work with our clients, we disclose everything about the market, who we're working with, the funders, and I think that's unique to our market. But in comparison, in particular to this market report, we will have, say, 10 different term sheets coming at us from different angles, all of which are stated differently. Now, one of the first issues we see is that you have certain investment funds, and I would really pick on the private equity guys here, that state interest on a retained basis. And by their calculation, they can potentially drop the number they use as an interest rate by calculating interest on a retained basis. If you then compare that to some of maybe the challenger banks in particular, they may not use that retained calculation. They might use an interest roll-up instead, which is a different way of calculating interest. All I would say is, when it comes to it, you have to make sure you understand how your funder is calculating that interest, so you can compare off competitors against each other. To give you an idea, retained interest will be chargeable. They basically charge interest on the interest account, which is part of the facility. What does that mean? It effectively means they can drop the interest rate number. So if, for example, you would have an interest rate roll up at maybe 8%, the retained figure might be something like 7.25, which seems better, but actually they might be one and the same thing. So understanding the interest calculation is fundamental. Also fundamental for you to understand that interest calculation relative to your cash flow and relative to your development appraisal. In addition to comparing apples with apples, one thing I'd like to highlight recently happened. We had a challenger bank which was up against an investment fund. Now, ordinarily, this really well-known challenger bank would have won this development proposition all day long. But actually, this deal was on the smaller side of things, and the challenger bank decided to charge charge an arrangement fee, which was a figure, a monetary amount, not an interest rate, or a percentage, should I say? Excuse me. And they charged an exit fee based on GDV. The private equity fund, on the other hand, they charged a percentage figure as an arrangement fee, and they charged a percentage figure as an exit fee, but that was based on debt. What actually happened in the shake-up is that the investment fund was pretty much costing the same as the challenger bank, while giving a larger loan and giving our client the ability to take equity out of this transaction so he could go again in something else at a really low rate. So understanding the breakdown of fees relative to competitors is absolutely essential, and it can be really easy just to gloss over it without looking at the fine print. Finally, I would just say that you really need to watch things like administrative fees, hidden fees, non-utilisation fees. So if you're dealing with an unsophisticated advisor, for example, they might just throw a number of arrangement fees, exit fees, and interest rates at you. You really need to look behind the basic structure of the facility and understand the fee structure to make sure you're making the right decision for your business. I'll move on to the next question, which I think Adrian would like to answer. Adrian, what about not analysing the market?
Well, firstly, I better squeeze this in because I think I'm going to have a challenge stopping you talking. So we've got 6 to get through today in 25 minutes. So let's get rolling on this. So not analysing the market. This is something that we see all the time, and it's across the spectrum as well. It's not only just inexperienced developers and investors doing it. We also see it with experienced bods as well. But let's start with the inexperienced end. You don't really have that many opportunities to impress. And if you're inexperienced and you're not using an advisory house, you're in a situation where you'll only get maybe 1 or 2 chances. If you've got your analysis wrong, you're going to lose credibility very, very quickly. And that's something that we do quite a lot of. It's the sense checking. So, for example, getting the GDV wrong when assessing solely on pound per square foot. And pound per square foot, my screen is not much, slightly bigger than a square foot, but per square foot in layman's terms is for every square foot of that flat or that house that you're paying, there is a monetary value attributed to it. This may be £200 per square foot. It may be, in some instances, £7,000 per square foot, and then everywhere in between. To bring a little bit of logic to that, Islington, where we're looking at a scheme at the moment, that would be in and around the £1,000 per square foot. A lot of the home counties would be £300 to £500 per square foot, to bring a bit of context. But don't get caught just in solely pound per square foot. Look at the capital value as well. Capital values, when you apply that pound per square foot, it may give you a value of, for example, 500 grand for a family house. I know there's not many areas left of that sort of ilk anymore, but let's use that as an example. You may then have a look at Rightmove or all the on the markets, etc. But you realise that a family house doesn't go for more than £400 to £450 per square foot. So make sure that you're cross-referencing across the 2 spectrums. Another area to look at, and we have seen this as an example in another part of the industry, student accommodation. It has to be near a university. Now, the university might not be built, and you have some inside information that a university will be built, hence why you're going to put some student accommodation in a certain area. But believe it or not, if you don't put the accommodation next to the campus, students will not go. Put a bus in the way, put a car in the way, put a train in the way, they're not going. I remember, if you didn't make it easy, you wouldn't go. So just keep that in mind as well. And the same can apply to offices as well, where you put in offices. Don't put them into the wrong location.
Adrian, have you ever witnessed where a borrower and a valuer have both got the GDV stated incorrectly?
Yes. When a valuer puts a wrong, and it's all subjective, it's one of those situations where you can have that conversation, but a valuer may put the wrong valuation, and it can work 2 ways. If they put what you perceive as the wrong valuation on it initially, i.e. it's lower because we are all optimistic people and we want to be aggressive on our end values, then you're in a situation where your residual value, your day one loan will be reduced. Now that's painful. That's not what you want. It's putting more equity into the transaction, reducing the client's return on equity. However, with the benefit of a crystal ball, fast forward 2 years, 18 months, whatever your bill phase may be, you're more than likely going to have a bill cost problem. You're probably going to need a little bit of extra money along the way because no one has that crystal ball. And we have seen it, but we've then been able to go back, negotiate with the valuer, and then they've realised, you know what, there probably is a bit of space in my valuation here. Readdress the valuation and then cover that difference and bring it up, rather than the client having to put their hand in their pockets. So yeah, I have seen it, but it can work both ways. Let's move on to number 3. Martyn, another one of your favourites, personal guarantees. Lots of conversations on this over the years.
Yeah, absolutely. So let's just take a step back in terms of, I don't want to teach people to suck eggs here. I know there's a lot of experience on the call, but what does a typical security package look like on development funding? Well, it consists of a fixed charge over the land, a debenture floating charge over the borrowing company, and a personal guarantee. And whenever you're sitting with a private equity fund, with a challenger bank, and they blaspheme about never enforcing personal recourse, bear in mind that you're signing up to joint and several liability under that contract. So you have to take it very seriously. But there's a few misnomers about personal guarantees, and just to touch on a couple of them quickly. First and foremost, if your facility is less than 55% of GDV, which is equivalent to say something like 60 or 70% of cost, you shouldn't be signing up to a personal guarantee. That's just not market rate. So if you've got 100% of the capital stack and you're putting 30 or 40% of that cost in by way of equity, in our opinion, you shouldn't be given a PG. In addition to that, we're seeing quite a lot of full facility personal guarantees. So, I mean, if you're looking at short-term market, limited PGs are relatively rare. So you may be signing a PG for the entire debt. But with development finance, it is very much limited. And so market rate for development finance personal guarantee is 20 to 25% of that debt facility. One thing we have really tried to push, and we're a big supporter of, is interest cover and cost overrun guarantee. And one of the reasons why that we feel that works really well is I think it's a fair response to personal recourse, given that once you sign up to your lending facility, within that facility agreement, it will say if there's a cost overrun on this deal, you as a principal borrower will cover that cost overrun. Now, if you have a cost overrun, it's part of our service and part of what we do on a daily basis to approach the funder and try to negotiate the best position for you to have help covering that cost overrun, whether that be 100% of the cost overrun met by the senior debt or otherwise, or partial payment along with equity coming in from our client. But an interest cover and cost overrun guarantee, I think, is a fair solution. Moving on to number 4, which Adrian will handle. What about working with an inexperienced lender?
A tough one to sell from the word go, because I mentioned in my last point, everyone is optimistic. We wouldn't be in this game if we weren't optimistic. We're going to buy something for the right price. We're going to build it for the right price, and we're going to sell it for the right price. And across those 3 spectrums, they all go in different ways. But I think, reflecting on the last 2 years, more so than ever before, working with an experience, let's turn it into experience, let's turn it into the positive rather than the negative. Working with an experienced lender will serve you so much justice over the years that you just, if you take the medium to long-term view, it will serve you well. Everyone will say they will deliver. Of course they will. But that's the reality of this game. They've got to say that. But they're with COVID and with the onset of COVID, we were in a lot of situations from March 2020. That seems like a distant memory now, doesn't it? But it's obviously not too far gone. But the way that some lenders behaved was so positive, so wonderful to see in respect of what happened. It was just full support. Now, you're getting into the front end of a transaction, and we are talking to you about depth of experience, and they're going to support you when things go wrong, a lot of the responses we get are, well, it's not going to go wrong. I know that this is going to be sold for that, and I'm going to buy it for this, and I'm going to build it for that. But the reality is, I can count on my hand, on one hand, how many things do not go wrong. It just there are situations where you need support. The facility overrun, you need support. You don't need default rates. The bill costs go up. I need extra money because I've invested into another transaction. Please, can I have some help? One of my investors has gone rogue. Please, can you help? There are so many situations that we can't foresee that we have seen in the past, and working with experienced lenders has really been a positive over the years. Martyn, on to number 5. Not enough consideration given to appointment of the right professional team. So be careful. You used to be a lawyer, still are. So be careful how you in this one.
To my dying days, always a lawyer. Well, look, I'm massively supportive of lawyers, the right lawyers, no doubt about it. Got to be the right instruction, though, right? Again, let's take a step back. So, what is the what professionals do you need to employ for a typical development finance deal? So, you've got valuer to opine on residual value and GDV. You've got your project monitor to opine on the build costs and justify the contractor to make sure you're suitable for the deal. And you've got your lawyer to come on board to complete the full legal due diligence, report on title, comment or prepare security package, security documentation, should I say. So in terms of a poor evaluation, obviously it's quite obvious that a poor evaluation is not something we want, but how does that affect a development finance facility? Well, if you have a poor evaluation, ultimately the GDV will suffer. Your loan to GDV as a percentage of that amount means the facility will be less. If the build cost and the interest rate or the interest accounts, you take them as constant, well then it's your day one that's going to suffer. What does that mean? It means more equity will have to be provided to on day one, and that reduces your return on investment, which is not something we want to see. As a business, part of our process is that we will have a pre-instruction desktop carried out by a valuer, surveyor, and that's a key component to us being successful in getting the right structure of deal completed for our client. Lawyers is the next thing that's really, really important. Often we see our clients, and that's on the borrower side, not the lender side. On the borrower side, we see clients going with maybe a less experienced lawyer, maybe a small backstreet lawyer, maybe somebody who's got less experience in development finance, but maybe as a whole service law firm, does trust, does property, could even do criminal, I don't know. But the bottom line is you need someone who's an expert, and you need someone who understands the whole process to deliver you an efficient process, because you can bet your bottom dollar the senior debt provider's got an all-star legal team that represents their security package, their facility agreement, and will be driving the process. So if you want a deal done efficiently, I would not undercut on your legal expenses. Always challenge them though. And finally, just on project monitoring surveyor, I just would always try and build a positive and proactive relationship with your project monitoring surveyor. So take him or her down to the pub after they've done their first initial report, or if they're out to do a drawdown report for the lender, have a nice coffee with them, butter them up, and see where that relationship takes you. Adrian, what about assessing a deal incorrectly?
Yeah, the cost of the project. Actually, that's leading on nicely from what you've just said there, the quantity surveyor, because your team of professionals will look at what you're going, and they'll present what they believe you're going to build the project for or the investment for. And I'm going to rewind 5 years or so here now. When we would be presenting to our valuers and to our quantity surveyors, some of them at that point were talking about £200 per square foot for build. Let's use a home counties region, a relatively accessible site or investment. £200 per square foot. I used to fight hammer and tong about it. I used to go absolutely ballistic. It is not £200 per square foot to build something. Now it is. Now we've seen that. We've seen inflation. We've seen lack of labour. We've seen issues with delivery on sites. as we're coming out of the pandemic, it has become very much a £200 square foot. I'm rather guessing that some are going to start talking about £300 per square foot, but I'll get there. I'll get grumpy about that when we get there. But this is something where experience and inexperience can shine through, because if you are putting your figures together on the back of a cigarette packet and not, again, going back, it's again very similar to analysing, doing your analysis, looking to a contractor or looking to the experience that you've had in the past, if you've had some, then show us why it's going to be built for. I think today, £150 per square foot would be quite aggressive. Now, I know there'll be contractor developers out there that will be on that figure, and I will look for evidence of that on a recent scheme. And if we can present that, great. If not, come on, then tell me why we're going to do for 150, rather than saying just because I can, we want to see that. And that's something that we really challenge, because, again, going back to some of the other points, you only have a small window to impress. And what we don't want to be doing is chasing our tail all the time. So assessing costs of projects is probably, again, one of my real go-to points when we're looking at a deal and assessing, to make sure that we're looking, if you're inexperienced, we can help you. We can put it all together and guide you. If you're experienced, make sure we're referencing some of your previous projects. We got through 6 on 26 minutes, Martyn. We've got a few minutes. Perfect. I thought we were going to run over. So I'm going to jump straight into the questions. Martyn, actually, you've answered one on there while we're talking from Deep. He said, in order to compare like for like, will Hallcroft put all comparable products into a standardized template to keep things simple for the clients? I think that's
it's probably a question I would have wanted Deep to ask, but thank you for asking that, Deep, because it's exactly what we do. So depending on the complexity of the deal and depending on the requirements of the client, there may be 2 lenders, maybe 1 lender, there may be 25 that we feel is appropriate to be approached. And then it's about us being able to demonstrate to you that we can compare apples with apples so you can make the right decision. It's not always going to come down to interest rate. It's going to come down to relationship. It's going to come down to support, being a supportive lender, supportive development partner. All of these things come into that. But yeah, absolutely, a full template is what we provide to all of our clients. Full disclosure.
Yeah, I've been impressed. We've really improved that recently. I've been really impressed when I've seen that presented to clients. It's very robust and transparent. So thanks for that, Martyn. One other question that we've got here in the private chat was around return on equity being neglected. And I think that, again, is a great point to be made. We get so focused on yield curves, on return on cost, return on GDV. Sometimes looking at what the client's return on their equity across a project does get neglected. I'm not saying we neglect it, but it's not the foremost of our concern in terms of looking at what their return on equity is. And I do think we need to bring that into the conversation, looking for every pound that a client puts in, how many pounds or pennies are they getting back based on that pound across the project, because that will be a key determiner of whether the business plan is going to be successful or not. Thanks very much for asking that question. Scott, I think we've answered your question. I hope we did. Thank you very much for joining. I think you said there that you jumped the gun, so that's brilliant to see. Martyn, unless there's anything else, we've hit it on the nail on the head.
Can I just address Stephen's point? If everyone has to get back to their desk for 1:30, then I'm sorry. Feel free to sign off. But I wanted to address this one. So Stephen asks, how long are transactions taking from start to finish? How often will lenders renege on terms at the last minute? So I'll answer the first question. Adrian, you asked the second part of that question. For me, it's incredibly frustrating right now that the keyboard warriors working from home in planning departments and local authority institutions are delaying developers from getting back to work. That's one problem. That's delaying things. Lawyers are taking forever to get taking forever to get transactions done. It's about making sure you give the right information in an efficient manner and also pushing your professionals. Working from home has been a disaster for getting deals done. Normally a deal takes 8 weeks, will take, double that length of time. But hopefully, as we get back to work and it's more normal, it'll come back to the way it used to be.
Thank you for the offering me the second part of this question. I was grinning as I saw it when you said Stephen asked the question, how often will a lender renege on terms at the last minute? So the last time I was involved in that, Stephen, would have been 2010. So a good while ago, and I'm not going to name names, but it was a horrific moment. And by the last minute, I mean the week of completion, they pulled out, and beyond disgraceful. The signs were there. Obviously, possibly I was in a situation where I lacked some experience of that situation. Now it doesn't happen. We know it happens in the market, but it doesn't happen with our clients. We just do not get to that situation. The experience will shine through. We will smell the rat very, very quickly. The one that says they will deliver, but then starts asking, if we've taken the risk with a new lender, a new fund, and they start asking odd questions early, we will pull that plug very quickly so that we have time to go back to one of our favorites, should we call them, I suppose. But it does happen in the market. We see it on LinkedIn. We see how some lenders are very excited because someone has pulled the plug, someone has done something. And we've obviously seen that in the COVID times, March, April, May, early. They were pulling terms because maybe they didn't have the cash. There was change of circumstances. But our clients haven't seen it since 2010, being transparent on that. Like Martyn said, if you need to leave, please, no offense, thank you very much for joining us. But there are a couple of other questions here that have rolled in. Yeah, let's do it. Richard's asked, is that £150 per square foot for build costs only, i.e. excluding other costs? That would be architects, quantity surveyors, structural engineers, etc., etc. Each their own, Richard, I suppose. There will be presentations where we will see presentations in the next few months where someone will say it's £150 per square foot, including all costs. So not sales costs, not bank interest, not fund interest, just professional costs. And we will ask them to prove that. Simple as that. And we will take them through the process that I mentioned there on that question. I do think it's still believable. I really do. I still think that some contractors, but they will be contractor developers. If they are pure developers and they're working with an external contractor, third party, I don't see £150 per square foot being possible southeast at the moment.
Let's take Anna's question as well. So what makes a good senior lender? That's a very, very good question, Anna. So my first reaction to what makes a good senior lender would be support. And that can come in any form, any manner of means. The best senior lenders in the market understand the stress that a borrower would be going through during the course of a development, which will never go to plan from the off. So for me, one of the big ones is to be a supportive lender. However, what do we see in the market every single day? What we see is lenders promising that they can deliver, lenders promising they can have a quick turnaround on deals, lenders promising sometimes that they're transparent and trustworthy. I don't think that should come into the conversation. That should be taken that they can deliver. That should be taken that they're transparent and they have a trustworthy process. What we're looking for is people who can stand apart. Being supportive is important. The second one is communication. The best senior lenders we see in the market have bulletproof process. They have a good sales function, they have a good origination sales function, and they have a really good credit process. And then they have a ops team that can handle any problems that come through. And having a constant dialogue with the borrowers is super important. Some borrowers are not so good at communicating. Maybe they've been contractors, not managed teams in the past, and they're now being successful in delivering. They need a little bit of hand-holding at times. And so I would suggest communication and support is what I'm looking for from the senior lending market.
A good question, Anna, and hello, Anna. Congratulations. Ask all these questions as you improve and become a great senior lender, which we know you will. So thank you very much for asking that. Frankie's coming in here with, we're going to take this as the last one because we've gone 35 minutes now. I can't get my head around return on equity. So we touched on return on equity there a little bit more, a little bit earlier. Isn't more borrower funds more costly, or is it opportunity cost of equity accounted for? Yeah, look, there is a fine line, there's a balance. Reduce the equity, you are more likely going to get a higher return on your equity. It's opportunity cost there. But if you start running over on time, if you start incurring default interest because you haven't done lots of the things that you say you will do, it's going to destroy your return on equity very quickly. The higher you go up the risk curve, the more likely that is to happen. So Martyn was talking there earlier about personal guarantees and being in an area on the risk curve that would be relatively low risk. Your return on equity there would be very conservative, but your risk would also be relatively conservative of destroying that return on equity or affecting it in a negative way. Go up the risk curve, borrow more money from institutions, from equity, depending on what you structure, then you start running over and you run into problems, your return on equity will be affected relatively quickly. So be careful. I think that's all, Martyn.
Yep, thanks for joining us, guys. See you next time.
Have a good afternoon. Thank you all.